Hey everyone, Phil Hodgen here. Thanks for joining us today. This is Section 965 workshop. I'm really glad to have Rufus Rhodes here to talk us through it. This 1 hour deal, we're going to sort of wrap it up 1 hour from now. No soul saved after that time. Rufus is going to gallop through his stuff. You've got slides. You have a handout that he's written. The handout happens to be the early update draft to his treatise that he's written. If you don't have the treatise, it's highly recommended. You have 6 volumes of paper or you get it online. Anyway, glad you're here. This is section 965, and let's hope it works. We've never done this before, and we're glad you're here. Anyway, I'm going to turn it over to Rufus, and he's going to start going through the slides. Afterwards, we'll have as many questions as we can.
Well, good morning. Welcome to Alice's Kansas. We are now dealing with something that is very difficult to understand, not conceptually, but just verbally. Congress simply did not do a good job in writing what it might have intended. In any event, let's see what we can do with the language that we do have. Okay, 965 is probably the most unusual section in the sense that it's of 1 year duration. After 2017 expired, the impact of 965 disappeared. It has a little, very modest carryover, but that's not significant for most of us. So you're dealing with a one-time shot here. And the problem is it's a very difficult shot to deal with. The persons who are impacted by 965 are U.S. shareholders. And since we're talking about controlled foreign corporations and subpart F, you'll find the definition of a U.S. shareholder in those sections. And fundamentally, it is a person who owns 10% of the voting stock of the corporation. If it's a foreign corporation, that person is a U.S. shareholder of the foreign corporation. The subject is a specified foreign corporation, which is either a CFC owned by anybody that makes it a CFC, or it is not a CFC, but it is a foreign corporation. It has at least one U.S. shareholder, and it has as a direct or indirect shareholder a domestic corporation. It's a curious breakout why they made that choice, but that's the choice that Congress made. Okay, let's go on to the next slide. Well, I would do that if I knew how to do that. Hang on for a second. There, what'd you hit? Okay. Take a look at slide number 4. And you'll see a very simple graph that Phil has put together. I didn't do the graph. I'm not that talented in the artistic sense.
Hey, Rufus, just we got to give credit where credit is due. This is from Mazars LLP on the East Coast, and they had it on a blog post. And if you go to our blog site, we have a reference to them. So we got to give them credit for this handy-dandy thing.
Absolutely. Credit it is. All right, so just work your way through that, and it probably will be pretty apparent what's going on here. Okay. Let's talk about an example. I'm looking at slide 7. Let's take Roco Limited, which is a Bermuda corporation with a significant deferred earnings. Gretchen Farmer, a U.S. person, owns 20% of the stock of Roco. Sally Jennings, a U.S. person, owns another 20%, and a Swiss corporation unrelated to either the two ladies owns the remaining 60%. Neither of the ladies needs to pick up any subpart F income as a result of 965. That's the easy case. If you look at the next slide, 8, I put that up for you in graphic form. Okay, let's revise the facts a little bit. Let's say that both Gretchen and Sally own 15%, but 15% is also owned by a domestic corporation, and the unrelated Swiss company owns 55%. Gretchen, Sally, and the domestic corporation need to reflect their pro rata share of deferred earnings in their 2017 income. The difference between example 1 and example 2 is that a domestic corporation is a U.S. shareholder of the specified foreign corporation. Okay, look at the next slide and they'll see in graphic form what we just went through. Example 3. Now we're talking about attribution, and this is where those of you who do tax returns are going to simply go crawl in your bed and pull the covers over your head. The U.S. person is a shareholder of a domestic corporation and a specified foreign corporation. The shares of the foreign corporation are attributed to the domestic corporation. That would mean that if we use Gretchen as a shareholder, even though she only owns 10 or 15% of the specified foreign corporation, and she may not know that her fellow shareholder owns an interest in a domestic corporation, nevertheless, she is required to pick up her pro rata share of the foreign corporation's deferred earnings. So, you didn't get the new one. Okay. This next slide doesn't show that what I had. Phil and I didn't communicate very well on that one. So there, if you mentally, because that's the last of them, yeah. If you mentally take an arrow from the domestic corporation and shove it up to a U.S. person that is also the owner of at least 10% of the foreign corporation, you'll get the idea of what we're talking about. But Gretchen really is the one who suffers here, or more accurately, her CPA, because she's going to very likely file an incorrect tax return. She won't know that she's supposed to pick up any income from the foreign corporation. Okay? Now, oh, here we go. Sorry. Go down to slide 14. And you'll see what I'm talking about. Gretchen owns the foreign corporation, 10%, that's it. Someone unrelated to Gretchen, Harry, who she may not even know exists, owns another 10% of the foreign corporation and owns a significant part of a domestic corporation. Attribution kicks in, and so the foreign corporation is deemed to have a domestic corporate shareholder, which triggers for Gretchen the pickup of 10% of the deferred earnings of the specified corporation. Okay. Let's take Gretchen again. ROCO SA is a CFC. I'm on slide 17. ROCO has never declared a dividend, generated U.S. effectively connected income, or had subpart F income. We make that statement because all of those factors, if any were present, would impact the amount of the that she has to pick up. On December 31st, 2017, ROCO's post-1986 earnings were $20 million. So Gretchen's share is $4 million. Now note that we don't care whether there is a domestic corporate shareholder or not, because ROCO is a CFC and a specified corporation is either a CFC or what we talked about before. So in this case, Gretchen picks up her pro rata share of the $20 million being $4 million. Notice that we're only talking about earnings generated while the corporation was a specified foreign corporation. Earnings that were earned during a period that the corporation may not have been a specified foreign corporation are disregarded. That means that the CPA is going to have to do some historical research. Okay, another slide. Gretchen Farmer owns 60% of ROCO Limited. Harry Rowe, another U.S. person, owns 20. Miscellaneous foreign persons own 20. Roco is a CFC and has 10 million of deferred earnings. So Gretchen takes 6 million into her income. Henry does the same for 2 million. Question is, what happens to the remaining $2 million that just is sitting in there and is not part of what is picked up as deferred earnings? The answer is that the U.S. shareholders are to treat the corporation's earnings as if they had been distributed to the non-U.S. shareholders. So that strips the deferred earnings down to zero, and that makes those U.S. shareholders a little happier. Let's talk very quickly about the deficit foreign corporation. What Congress was concerned about is a U.S. shareholder who holds an interest in more than one CFC, and one of those CFCs has generated a deficit in retained earnings. Congress allows, for purposes of 965, the U.S. shareholder to combine those corporations so that the amount picked up as deferred earnings is simply a net of the plus and the minus. In the example I'm giving you, that turns out to be a zero. So Roco does not pick up any income, even though one of its CFCs had deferred earnings of $100. Now, what happens later is that the deficit foreign corporation is treated as if it had earnings equal to its deficit, effectively wiping it out, so that in future years, any positive earnings aren't going to be sheltered by the prior deficit. Another example. Roco Inc. Good. Sorry, we thought that's.
No, it's okay. Carry on.
Okay. Roco Inc., which is a domestic corporation, owns 2 CFCs. So, sorry, that's the example I just was talking about. So we'll go on to this one. The calculating of the tax, we end up, as I mentioned to you, with a zero. But supposing that there's a future distribution, then what happens is you get into the GILTI, G-I-L-T-I rules to determine what the tax is on a future distribution. And we may have a program on GILTI at a later time. Let's talk about what they call the participation exemption, which essentially is simply a deduction. Every shareholder, not just a domestic corporation, but every shareholder that has included in income any deferred earnings is entitled to a deduction. Now, here is where the code becomes absolutely unintelligible. The theory is that the deduction is designed to generate a net tax on the amount of the distribution for domestic corporations equivalent to 15.5% or 8%. And I'll tell you about the or in a second. If you look at the language in 965, you will find it to be absolutely, as I say, unintelligible. And it just is beyond me how they could pretend that this is meaningful legislation. So let's assume Roco Ireland has generated $10 million in deferred earnings. That $10 million is converted to Subpart F income on December 31st, 2017. Now, here's where you need to do a little more research. You need to identify how much of the $10 million was allocated to what is called the cash equivalents or what was dedicated to the actual assets that Roco Ireland used in its business. In this case, we just arbitrarily said it's $8.5 million is held in cash or cash equivalent. So the cash portion is what is multiplied times a 15.5%. The remaining $1.5 million is multiplied by 8%. So if you look at slide 29, you'll see how we come up with a final tax bill for Roco of $1,329,925, just because it's using those odd percentages. Here is what you look at to determine whether or not you have assets in a cash position. Obviously, cash, accounts receivable, the fair market value of traded securities, commercial paper, foreign currency, and short-term debt. The foreign currency is probably the most problematic of that list, because if you have an operating CFC, almost without question is going to be operating in a foreign currency, and that foreign currency, at least is my thinking, is something being used in the business, but nevertheless you count it as cash. Okay, let's talk about the foreign tax credit for a second. The foreign tax credit has always been a difficult part of the Internal Revenue Code, but in this circumstance, what we're talking about is identifying how much tax is actually going to be creditable that the specified foreign corporation may have paid. And the theory is that the foreign tax credit is to be applied only against that portion of the deferred earnings recognized as subpart F income that is subject to tax. So the part that isn't subject to tax by reason of the deduction we just talked about doesn't get the foreign tax credit, nor can the U.S. shareholder take a deduction for foreign taxes with respect to that number. Okay. Needless to say, there is going to be a series or group of individuals and corporations that have a significant tax to pay as a result of this new legislation. Congress recognized that and offered those taxpayers an election. Note, it is elective. It's almost impossible to give some thought to those who would not take the election, but some might not. Those who do, however, have a really pretty small tax to pay in the beginning for years 1 through 5. On slide 34, you'll notice that it's 8%, 15, 20, and 25 of the actual tax liability. There are certain things that the taxpayer can do to trigger an acceleration of the amount of tax due, but if you simply pay attention, pay the tax in the installments when due, then you're not going to have a problem with that. The first installment is due with the 2017 tax returns. Now let's look at what happens if the domestic corporation is an S corporation. For reasons which I simply cannot understand, shareholders of an S corporation get a significant tax break that shareholders of a C corporation do not get. The shareholder of an S corporation may defer paying the tax on the amount of subpart F income that the S corporation is deemed to have received for as long as it avoids a triggering event. So clearly that could be a 10 or 15-year period. Example, our old friend Gretchen is a 50% shareholder of Roco Inc., an S corporation that owns 60% of Harco Limited, a Bermuda corporation. Harco has 5 million in deferred earnings. So Roco picks up 3 million of subpart F income. Gretchen can elect to defer payment of tax on her share of what Roco picked up until she suffers a triggering event. So that brings us to the question of what is a triggering event? And they're pretty simple. The corporation ceases to be an S corporation, and a liquidation or sale of substantially all of the corporation's assets occurs, or the taxpayer transfers one or more shares of stock in the S corporation, although exceptions exist for that. Pretty simple triggering events. And with a lot of S corporations, none of those triggering events is going to happen for quite a while. Once the tax finally becomes due, the shareholder of the S corporation can then elect to pay the liability in installments. So the owner of an S corporation is in far better shape from the standpoint of cash flow than is the owner, as I say, of a C corporation or a straight individual shareholder. There are certain reporting requirements for those folks that do the S corporation election, but that's pretty easy for you to do as her advisor. Let's look at the tax on individuals. And the reason for this, as you'll see, is that the tax is different for an individual from a tax on a domestic corporation. Note that Section 959 does not impact the tax rate. That stays the same. And we're not talking about the new tax rates for 2018. We're talking about the old tax rates that were in 17, 16, and so forth. So the taxpayer goes through the same calculation and identifies how much is equivalent to cash and how much is equivalent to the other items that come under the 8%. The tax for purposes of determining the relevant deduction is the corporate rate, not the individual rate. So what I mean by that is that, or as an example of that, Gretchen, let's say, received a 951 distribution of $100,000, all of which fell into the cash basket. She is entitled to a deduction of $55,700, leaving her with taxable income of $44,300. Her tax, when you multiply the taxable income times her maximum rate, is $17,543, whereas if it were a domestic corporation that received the $100,000, the corporate tax would only be $15,500. One thing which we don't have on the slide that you might want to think about and probably have been talking about is an election under the Subpart F rules to treat a domestic corporation, to treat an individual as if he or she were a domestic corporation. That has a lot of attraction because the tax rates are lower at both the corporate level and at the 965 level. The problem is that if you do that, you have effectively locked the money into a domestic corporation. And when you try to take it out, you then get hit with the secondary tax. So it may or may not be a good idea to use that election. Whether or not it is just requires pencil pushing and planning. Okay. What now, Coach?
The answer to what now is bunch of questions. So you have some in front of you, and we have a bunch that are coming in on the chat. We're at 9:25. We're going to go till 9:55 on questions. So we'll just start banging through them as we can.
Okay. You want to start with the ones that are online or these?
Well, let's start here. Can the section 965 transition tax be offset by a prior year overpayment? That's from Ben. I think the answer is yes. If you've got an overpayment, you can apply it to any tax liability, right?
Yep, that is correct. Yeah, that's easy. Overpayments would just apply to the tax liability. But along that line, one of your folks said, if the cash position of the specified foreign corporation exceeds the deferred earnings, which is the number you use to calculate the tax, and the cash position is irrelevant in terms of calculating the tax, other than between what we talked about before, between the cash and the asset investment. But if you have $100,000 in cash, but deferred earnings are only $80,000, then clearly $80,000 is the magic number, not 100.
Okay. Well, related to that cash position thing, there is a question on the chat says, does cash position of CFCs offset each other when calculating transition tax? So I assume this means you got a couple of CFCs, one's got nothing, one's got all cash. What do you do?
Okay, you take each CFC separately, and whatever the result is from each separate CFC, the only exception to that being is when you have a deficit CFC, then you do what we talked about earlier.
Another quickie question, just confirming, who this applies to. Is a foreign corporation a specified foreign corporation if a 10% shareholder is an S corporation?
Yes.
Easy. We like easy.
Yes, that was easy. And notice that it automatically meets the domestic corporate shareholder requirement.
Okay.
In fact, let me just, while we're talking about, one of the major problems that this section presents is information. How can you, as the CPA or the tax preparer, determine for a minority-owned specified foreign corporation what the retained earnings really are? As you may or may not know, foreign corporations tend not to be very forthcoming when it comes to their financial information. And you may have a very difficult time extracting from whoever the controller is or the treasurer of the specified foreign corporation the information you need in order to file the tax return for your client. I don't have an answer for that, sorry, but that's some struggle that we're all going to go through.
Okay. There are a number of people who have asked variations on the theme about the interaction between 965 and the net investment income tax, the 3.8%.
Sure. Okay. Let's talk about the net investment income tax. In fact, I'm going to expand that a little bit to talk about the difference between the recognition of income and the actual distribution of money. 965 does not require a distribution of money. So if Apple wants to keep $77 trillion offshore, it can do that. There's nothing that encourages it to bring that money home. Well, that is pretty important because most state income taxes won't crack 965. California doesn't, as far as I know. I doubt New York or New Jersey does. Illinois, don't know. But the point being, if the state waits until actual cash is distributed, then there's a break on the corporate decision to bring cash back to the United States. The same is true for the net investment income tax. You do not pick up a deemed income from 965 under the net investment income tax. That happens when there's a dividend coming out of the foreign corporation, which, even though it is not taxable under the normal income tax rules, at that point, it triggers the net investment income tax.
Okay. There were some questions here. I just want to note that on the IRS website, there's a web page telling you how to do the paperwork for a return. And you can either ask the Google, with the right magic words, how to find it, or you can go to our website, and the top blog post there has the link to that, plus a bunch of other stuff on 965. But there's someone asked to just follow up, please go over the disadvantage of doing the 962 election for someone who's looking at this. So Why would a human not want to be taxed as a corporation?
Okay. The question is what the client plans to do afterwards. If the client has no particular plans to use the corporation, then when you run the numbers of first paying the tax at the corporate level and then looking to your client and saying, okay, now what? And the client says, well, I don't know, let me have the money. And you then run the second set of numbers, which shows there's either a dividend at the 37% probably rate, plus, of course, the state tax, or there's a liquidation, which would be at the capital gains rate, providing the corporation has been in existence for a long enough period of time. So on balance, I think when you run the numbers, it's not going to be economic to use 962. When it is economic is if your client has terrific plans that he can exercise through the use of this 962 corporation, which remember is not a corporation. And also remember that 962 election doesn't make it a corporation for state purposes or any other purpose. It's only for federal income tax. But if your client has business plans where he can utilize that money and not have to distribute it or liquidate this constructive corporation, then yeah, maybe it is worthwhile.
Okay, there are a few variations on the theme about the interaction between foreign tax credit carry forwards and the tax being imposed by 965. So I assume.
Oh, no, but well, there's no different foreign tax credit under 965. 965 simply tells you how much of a credit you can get, but basically it's still the same old 901 tax credit discussion. And don't forget 902, which is now gone, is still effective for 2017.
Okay, another question. Are we just using the December 31st, 2017 tax rate for the calculation of the tax? So we're using 2017, right?
Absolutely.
Okay.
Because the income is deemed received as of the end of 2017.
There are a few variations on the theme of partnerships. So here's one. If one partnership has a lot, oh my God, this is scrolling away. If one partnership has a lost CFC and another one has a positive E&P CFCs, do you offset those? So how do you sort of flow everything upstream through pass-through entities when you're doing these offset calculations? Or is this one of these things the IRS hasn't told us, we may have to make it up?
Right. That's going to be, you're pretty much on your own until we get some guidance on that. And indeed, if we get guidance and you've done it not correctly with respect to the guidance, you may have to go back and amend.
Yeah, okay. Here is a question. A U.S. green card holder takes a non-resident position under a treaty. Would the transaction help tax apply? So I can.
With the what?
So you have a green card holder who has a CFC living abroad. They say, I know what I'm going to do to defeat this. I'm going to make an election under the relevant treaty to be taxed as a non-resident alien. So what happens?
Okay. That gives me a chance to talk about something that is really pretty important for us in this business. And that is that the treaty non-resident provision is really pretty narrow. It doesn't impact anything that is not covered by the treaty. So as a resident alien, except for the treaty, you're a dual resident and you have dual responsibilities. One, you're required to file every return that a normal resident is required to file. That means 5471s. It means the FinCEN if you have a foreign bank account, which you probably do, and 3420s if those are appropriate. In other words, whatever form you would have to file, but for the treaty, you still have to file. What you get from the treaty is you don't have to pay any tax that may otherwise have been generated. And this is one of them. You won't pay the 965 tax, but you're sure going to file a 1040 NR and follow the instructions on how to complete it properly?
So this is one I don't have an answer to, except I fear it is an awful answer. And it's not in the chat, but it was asked to me personally. So you have a CFC, and in 26 has been there for 20 years and accumulated a lot of E&P. 2016, your client buys in a 25% share, and now, hey presto. So does that person start calculating his or her share of the transition tax starting when he or she became a shareholder?
Nope.
Or
Nope. That shareholder goes back to 1986 and picks up the income just as he or she would were there a general liability that was undisclosed. Same thing. It's not a good answer.
that was my suspicion. It was not the answer I was hoping for, but it was the answer I expected.
Yes, yeah. Which means that for those of you who are lawyers listening to us, you now have another item on your checklist when you put together, or you should have when you put it together in those days. But the problem is you didn't know about this at the time. And so it really is a lousy result.
A quick sideways follow-up on 962. Kay Rosen is saying, isn't a 962 an election that needs to be made every year? So if someone decided they want to do that, is it a one-shot? They've made the election, they've protected this lump of income forever?
I can't say off the top of my head that it's not annual, but I don't think it is. I think it's a one-time election. And then the constructive corporation now is yours, and it sits there, and you have to do something with it if you want to. Which means, I suppose, you fall in 1120.
Yeah.
So with your 1040, and for the shareholder that made that election, I guess an 1120 is now due.
Yeah. Well, this is going to be fun.
Yeah. Okay. I have some here too.
Okay, take them away.
Just to refresh your memory of what we've talked about, the question is, if a taxpayer who is the only U.S. shareholder in a foreign operating company in which he owns 30% of the company interest, does 965 apply in this scenario? What makes that an intriguing question is because although on its face the answer is no, what you need to do as that taxpayer is some investigation. Is there, by attribution somewhere, a domestic corporation which is deemed to own a part of the foreign operating company, in which case the taxpayer in question has a deferred income item? If not, then he's fine.
Rufus, we got a couple chat people telling us that 962s are annual elections. So
oh, they are.
They are. So okay, thanks, chat people.
Well, that's interesting, isn't it? Which means if you don't make the election, it automatically dissolves. That's interesting. I'm not sure what happened. That's the reason I thought it would be not annual. But if it's annual and you don't make it, is it an automatic dissolution? I suppose so.
That would be fun.
Yeah, right. Okay, another question. Our understanding is that for individuals, only U.S. persons who have invested in a CFC is affected by this repat tax. If a U.S. person individually owning 11% of a foreign corporation, which is not a CFC, do the deemed repat rules apply? I think we've pretty much answered that in the prior question and in the talk. It all depends on whether or not there's a domestic corporation floating around out there that has a U.S. shareholder interest in the foreign corporation.
Okay, we're back. My comment and question about the person who bought into a CFC in 2016, someone followed up and said, well, let's pretend it wasn't a CFC before 2016 when this person bought in, but it became a CFC because of that buy-in. And
okay, that's a terrific follow-up question. And the answer is what determined whether or not it was a specified foreign corporation at the time the shareholder purchased his shares. clearly it became a specified foreign corporation under these facts, but you have to determine whether prior to that time it was specified, because the only deferred earnings that we are talking about are those generated when the corporation was a specified foreign corporation. By the way, which we haven't focused on, but it's right out there, earnings generated prior to 1986 are not included. Just coincidentally, I happen to have a client who has large deferred earnings, but it was all generated prior to 1986. So he doesn't have a problem with 965.
I keep pushing the wrong button to mute and unmute. Okay. Um, a couple of follow-up questions on variations on the theme of the net investment income tax still coming up. Just exactly why? So it does not apply because it's Subpart F income? Is that the concept, or?
No, it doesn't apply because that's what Treasury says.
Okay, there you go.
Yeah. Yeah, I thought personally, before I read Treasury's announcement, that they wouldn't take that position, that indeed they would treat a constructive distribution the same as any other dividend. And that makes much more sense to me, but that wasn't the route they chose to travel. And so that's why I gave you the route I did.
Just off the top of your head, foreign tax credit question, which bucket do you put it into?
Oh, that's a good question. It ought to go into the general bucket. That'd be my guess. It doesn't classify as any other bucket, or basket, as I call them in my time. Don't forget the additional baskets to 901 pick up in 2018. So we're only talking about the old baskets, and I don't think it falls into any of the old baskets.
The chat questions, where do I find this Treasury announcement? Which one is it? For those of you who are on this, afterwards I will throw a link up on the blog post that has all the 965 links on our website. But which one is it?
Which link was you talking about?
We were talking about net investment income tax.
Oh, yeah. Oh, no, but that's an old position. That's not recent. That's not a 965 position. That was published by Treasury. Well, as I recall, the net investment tax income came in 2013. And I think Treasury made the announcement at the end of 14 or maybe the beginning part of 15. You probably could find that. Well, one, I know you can find it in my book because I put it there. But also you probably can find it on the IRS website if you just fill in the question.
Okay, so for you, those of you in the audience, especially Sarah, who asked the question, we'll track it down. We'll throw the link on our website on that blog post that has all the 965 links, so you can find it.
Oh, that's good. Okay.
Yeah.
One of the things that we haven't talked about, because it's not related directly to 965, but I have a question which raises the question. Under the way the Internal Revenue Code works in terms of fiscal years, the CFC is required to have a fiscal year coincident with that of its major shareholder. So if you have an individual who owns a CFC, that CFC is not authorized to have something other than a calendar year for its fiscal year. And so most of the questions relating to an off a calendar year that is a fiscal year discussion don't apply. Where it does apply and where it's fun is when we go back to Gretchen and Sally in our example. If that corporation, which is owned primarily by a Swiss corporation and is not a CFC, has a fiscal year, which so many of them do, then the question is, how do they calculate the deferred earnings at that point? And there's some guidance issued. The service issued a couple of notices, which are probably on your blog, aren't they, Phil? About how to do the calculations. And as I recall, how to do the calculation for a fiscal year corporation which meets the standard is on there, and you can walk it through. But it, like everything else, it's a projection of what the income is going to be and figuring the tax at that point.
Okay, we have another question. This is sort of the aftermath of our new world order that we have now for tax. What happens if there's a foreign tax in future years on this foreign corporation?
I'm not sure I understand the question.
I think this is from Hannah. Hey, Hannah. It's what happens. We go through the transition tax and everything's paid and everything's happy, and now it's 2019 and there's a foreign income tax imposed on this foreign corporation.
Okay.
So now that we have we're now, as far as I can tell, this is all this brand new stuff that we've been blessed with, right?
Yeah, now you're into the guilty discussion. We're not any longer in 965. And guilty, which is equally difficult, as I say, is going to be the subject of the next podcast that we do.
Yeah, and just so you know, heads up, we're going to say to all of you, hey, do you want more of this? And if you do, we will do some more, and if you don't, we won't.
Guilty, by the way, is 951 Cap A, and it's brought in by the 2017 Act.
Okay. Okay, so we have here an interaction between expatriation and this thing. And let me see if I can find it again. 50% plus shareholder expatriates in 2017, so they're no longer a CFC shareholder at December 31st. So what do we do? I mean, on the one hand, we've got
965 doesn't apply. That's easy. And the reason that Congress allows that is because the expat has to pay an exit tax, very likely, anyway. And so the tax was picked up when that shareholder expatriated.
Okay. Do you have any on that paperwork? I mean, these are just sort of spinning by. I'm trying to catch out. There are various questions around the theme of what constitutes the cash position. So can you just go over that one more time? What do we include? What do we exclude in terms of including that?
Okay, let me go back and pick that up. And just for your information, it is slide 30, and it is cash. Net accounts receivable. By net, they mean you reduce your accounts receivable by the amount of accounts payable and uncollected. The fair market value of whatever traded securities that the CFC may have, commercial paper, foreign currency, and short-term debt. All of those come into the cash position. Now, one of the things we haven't talked about, if I can pull it back up out of my memory, is what is included in deferred income. Deferred income excludes certain items, the most important of which is Subpart F income. If the corporation has had Subpart F income and it is a CFC, then that income is deemed to have already been distributed. So it is not included in the deferred earnings account. It should be held under a previously taxed income account. So just when you're looking at it, make sure that you're not double counting.
Okay. There are also a few questions about E&P. So the magic numbers are E&P, whatever that means, as of November 2 and December 31st. So bluntly put, how can we manipulate E&P retroactively so that it's lower and therefore the tax is lower? Is that's an accounting method question, possibly?
Yes, and certainly I think you're going to find it's going to be very difficult to do that because one, you're taking retroactive action, and that's always iffy. The reason for the November 2nd date was that Congress anticipated that with the bill in the hopper, that there would be action taken between November 2nd and December 31st that would significantly reduce E&P. And that was the reason they're trying to make the November 2nd date so important to the calculation of E&P, because you take the higher of the number at those dates.
Okay. Another sort of, DIY remedial effort for this stuff. Patricia says, can you do an amended tax return once you file your 2018 tax returns to carry back some foreign tax credit to get a refund of the 2017 transition tax? For instance, making a big dividend in 2018 and presumably creating a foreign tax credit and you roll it back. Any thoughts on stuff like that? Or
yeah, but the big dividend in 2018 would necessarily be of the previously taxed income as a result of 2017. So
okay,
and that's already previously taxed, and so that's taken care of.
Okay. I mean, just generally, this is not on the questions, but is there at this point, we're just kind of stuck? Whatever the facts are, and it's really financial statement re-engineering is not possible.
I don't think so, and I think the risk is pretty high if you try to do it.
Yeah.
So the answer to that question is yes. If you take a dividend in 2018 and the foreign country taxes that dividend, you can take that credit back and carry it backwards under the normal rules.
Great. That was Hao Shen. So thanks, Hao Shen.
Well, okay, but bear in mind with that 902, which is the deemed paid foreign tax credit, is gone. There ain't no 902 anymore. It's effective 1/1/18, granted, but it certainly impacts the question of whether you even have a foreign tax credit available.
Okay. Another question. So in some countries, U.S. individuals cannot own real estate directly, so they use a local corporation and they're the shareholders. That's a CFC, correct?
That is correct.
And this person is kind of stuck with whatever it is, whatever it is. Yeah.
Well, not necessarily. Depending on the country, if the corporation is eligible, you might have the shareholder make a retroactive check the box election. This is a far cry from 965, but certainly it's something to give some thought to in order to avoid the characterization of being a foreign corporation that triggers 965.
Okay. Yeah, we got one more question because we're at 9:53, so we'll deal with this, and it's enough for us to chew on. So entity became a CFC during 2017. Before that, it was a PFIC. So what do we do with that? So
a PFIC is not a specified foreign corporation.
Okay. So we would just have to look at, once it became a CFC from that moment forward, we'd have to look at E&P for that portion of the time, and then
sure.
Yeah,
probably wouldn't be much.
Yeah, right. And then, but you keep your lovely PFIC results forever until you wash them out.
That's right.
Yeah. Okay. Well, this has been great. So far, there are still 143 open questions in the chat. So what I'm going to do is I'm going to capture these as best I can, and we'll start to try to answer these on the blog. Thanks, everybody, for joining us today. This was great. We did it on a whim, and I'm glad so many of you wanted to join us. So there's a little thing there. Please answer the questions. If you have additional comments, questions, suggestions for the next session, email me, Phil, P-H-I-L, @Hodgen, HODGEN.com. If there's something we should fix in the slides or the materials or something like that, we screwed something up, or math, please tell us. Math is hard.
Talk about overwhelming.
Anyway, and there we go. And I'm going to give it back to Rachel because she's running the whole show booth, and we're going to kick it off and get you out of here. So good luck, and please, again, follow up with questions.